president's key economic team goes to China. After a whole night thinking, I say I still want to do it.
Hey there, this is Rui Ma, your China Tech Analyst. Welcome to TechBuzz China Livecasts by Pandaily. As the name suggests, these conversations are recorded live and then edited for your listening pleasure. Some of these chats are open to the public, and we welcome you to join us. So be sure to follow us on Twitter or sign up for our mailing list to get notified. Remember, members of TechBuzz China Insider get priority access. So if you're an investor or operator looking to join the smartest community online focused on China tech, go to techbuzzchina.com and see if you qualify. Extra thanks to our partner pandaily.com, where you can learn everything about China's innovation. Thanks for subscribing, guys, and do give us a review. Albus, tell us more about China Growth Capital and also yourself. What does the fund do? What's the size? What's your strategy?
Thanks, Ray. Hi, I'm Albus, and I work for China Growth Capital. We are early stage venture capital fund. We're based in Beijing. We manage US dollar and also RMB funds with total asset under management about $1.4 billion. We do three sectors mostly. One is like consumer, that includes consumer internet and consumer brands and services. And we also do enterprise software, SaaS, and also some investment in high-tech sectors, including medical tech and autonomous driving, etc. I mostly focus on the consumer side. I've been doing investments in consumer internet, e-commerce, marketplaces, and also focusing on consumer brands in the past 2 to 3 years or so.
So we talked about this because you guys used to be really big in fintech, and now it's really shifted into, like you said, this deep tech stuff as well as consumer brands. And you had mentioned that you had stopped really investing in consumer internet and e-commerce marketplaces. What's the reason for that?
Yes, actually, we did spend a lot of time and capital investing consumer internet and also e-commerce platforms, and we actually ended up with some good portfolio too. But in China, we see that maybe since 5 years ago, there is no opportunity for a new platform to emerge quickly anymore. For example, we have a portfolio called Miss Fresh in China. It's real-time grocery delivery services in China and is one of the biggest players. And they started their company in about 2014. We think that might be the last time window for you to start an online platform business, because back at that time, they can still acquire users at a very low cost and at a very high efficiency. And they can have a viable kind of business model in terms of user acquisition cost and also the user's lifetime value. It actually did that via WeChat viral kind of marketing. But after that, we haven't seen any internet products or platform services that could grow as fast as before. That's because the traffic were getting so expensive, and people are spending 90% of the time on the major internet platforms, like Taobao, like WeChat, all the big names. And for a young internet startup, you just didn't have the momentum or the time window or the opportunity to acquire user at a lower cost and grow fast anymore. However, with those internet services and e-commerce platforms already very viable and very efficient, that's a lot of younger consumer brands are starting to grow their business on those platforms. You can get your word out, do your marketing reach potentially hundreds of millions or even 1 billion customers. And also you can sell your product, Taobao, Tmall, or Jingdong, or even Douyin right now very efficiently. We have those marketing channel and also sales channel ready to go. And that's like infrastructure has already been built 5 years ago. Right now, we just need better product and brands. That's why those new consumer brands in China are very efficient and they're getting a lot of attention now.
Got it. So the infrastructure building was from 2010 to 2015 or so, and then now it's much more economical. It's a much better business to build brands on top of that. That makes a lot of sense. For the brands that you're investing in, though, I just remember very clearly you had mentioned some metrics, right? So maybe you could talk about what does that growth look like these days?
It's amazing because in the past couple of years, we have no idea how we should do a D2C brand in China. And right now, the markets are just so competitive and everybody is so efficient right now. Like to give you an example, say if you start a new skincare brand in China and you start off online, try to selling your product to customers through social media, through e-commerce websites. If you want to be competitive in the market, you have to reach maybe $5 million in monthly sales within your first 6 months of launching the brand. So that's actually a crazy rate, like from zero to doing 5 million a month. And you have to do that within 6 weeks, 6 months at USD.
Oh,
so
wow.
that would
Okay.
translate to about 30 million in RMB.
So you had used the words DTC to describe some of these brands that you're investing in, which stands for direct to consumer, which is a business model that was really popular here in the US a couple years ago, but a lot of enthusiasm has died down because none of these brands got super big. What are some of the differences that you think exist between what we saw here in the US versus the DTC brands that are growing in China right now? Why is it a better opportunity?
First of all, in the US, most of the brands here launch their business online and they tend to sell to their customers through their own websites or even apps. And that's because in the US, the e-commerce market is not as highly, concentrated as in China. Amazon in the US is the biggest player in e-commerce, but it only has about 30% of the market maybe. And whereas in China, Taobao dominates about 70%. And the rest, Jingdong has 10 to 20, and Pinduoduo and Douyin right now growing very fast. People use like WeChat for over 1 billion people. That's a very dominant kind of IM or messaging services too. So in China, brands, they don't build their own websites or try to, reach and retain customer on their own services. They try to reach out customers on those big platforms. They sell to people through Taobao, Tmall, or Jingdong, WeChat, or Douyin, and they do their customer outreach and acquisition in some different way compared to the US. Because in China, people, when they do shopping, they don't go to the brand's official website. We don't have that customer habit in China. We don't go to Nike.com to shop for Nike. We go to Taobao and search for Nike. And that's where Nike in China will build their product and services. And so we have some operational differences compared to the US D2C brands.
Mm-hmm. Amazon percent of e-commerce right now vary a little bit between 40 and 50%. It is still substantially lower than Alibaba's share of e-commerce in China.
Yeah.
That's on the marketing and front end side. Could you talk a little bit also about the supply and manufacturing side?
I think one of the biggest advantages of this brand starting off in China is that we do have a very strong foundation. Chinese factories and manufacturers actually have experience and know-how and the ability to produce global standard stuffs and at a low cost. But in the past, the consumption market are just overseas. Right now, the Chinese people are getting richer and they want to, buy better stuffs, products. Startups, they can actually find very high quality, very efficient manufacturers very easily. That has really saved them a lot of time. Let me give an example of that. We have a small portfolio working on beverages. And the founder actually wanted to change a little bit on the shape of the bottle. He said that he just had the idea, talked to his supplier, and he got a model in his hand, maybe within 6 days. And the next week, they can already producing hundreds of thousands of these bottles in the factory per day. And that's only next week.
What percentage of the portfolio would you say right now is consumer brands?
I think in our funds portfolio-wise, I think purely brand businesses, they're about, I would say now about a dozen.
About a dozen. Yeah. Okay. So that's
10
pretty
to 15
significant.
maybe.
So out of these dozen or so portfolio companies, which one is your favorite and why?
Out of the consumer brands we have invested in, one of the portfolio that I really like is the brand is called Maya Active. You can think of it as Lululemon in China. Designs and manufactures women yoga pants and athletic clothing for the young women in China. It's very typical for a global brand to have a very centralized product design and marketing strategy. So none of this product is tailor-made for the China market. Maya Active product, design-wise, it has some small features, tweak there, change there, that really fits the China young girls' mentality and needs.
They started off as an online brand first and then they moved into offline, right? Starting off as an online brand and then moving offline seems to be really common these days. Is that something you recommend for every single brand that you invest in? And why is that a good strategy?
It's definitely a very common strategy that we see right now. We call it omni-channel. Customers have to see you everywhere, and you have to be online, on social media. First of all, online, we used to say that it's a limitless kind of shelf because the traffic are endless. So there's always going to be some younger brands that is going to compete with you. But what is different in offline that it is, first of all, more costly to do, and also it's harder to be replaced in offline. You have your distributors, you have your stuff. That's going to be harder and more costly for your competitors to compete with you because it's all about location, your presence.
You said earlier that you invested in a beverage company, right?
Actually, a couple already. We have a local brand called Oat in Chinese. Oat manufactures very good, high quality oat milk in China too. Sells online and also in thousands of the CVS stores in China right now. And also we have another brand. It's a sparkling fruit beverage. It's a very Chinese drink and it operates in the market of Wang Laoji.
Yeah.
Sells in restaurants. So when you're having hot pots or spicy food, you want something refreshing and helps you to digest.
Why is it that the investment required isn't actually as much as we might expect for an offline store?
At this moment, I think those offline stores are the most popular sector. Right now, we have heard brands, they only have about 10 stores maybe, and their valuation is above 1 billion RMB already. That's about $150 million in valuation already. So per store wise, they're more valuable than a Starbucks store. I think competition is definitely the key behind those investments or high growth rates, because once a business model is proven, like your store's unique economy works, I have proven that you are a good offline business model and you can make money actually. So investors are now just giving you a ton of money for you to just copy and paste to expand. And because if you don't do that, your competitor are going to get the next best location, have the most customers.
But after they do the stores, they're still not all selling offline. They're still selling online because most of these businesses have also a substantial online presence that they're trying to cultivate.
In China, one of the differences is that the delivery cost is pretty low. If you want to get your stuff delivered, the example, like in the US, you don't get your 1 cup of coffee delivered by somebody. You have to tip a lot. But in China, definitely. Luckin Coffee, Fish Eye Coffee, Starbucks right now, you get your coffee delivered for a small fraction of the price as a delivery cost. So those companies are really, we call it O2O, like, or online OMO. We have new words, is online merges with offline. Those brands are, we say, omni-channel, like they're online, offline, they're everywhere.
What is the percentage of the products that you are looking at have their own R&D, or are most of them going to ODMs who can do a lot of the design as well as the manufacturing?
I would say right now, most of the new brands are still very operation and sales focused or sales and marketing focused. They do outsource a lot of manufacturing, supply chain, and even product design wise. I think those startups are good at like design or customer experience, but they're not experts supply chain, manufacturing, raw material wise. Actually, we're looking for companies or teams with stronger background in supply chain or manufacturing, or even some innovations in material, something with more deep innovations, because the competition is really driving those brands to compete at a higher level.
What is the potential for some of these businesses to expand internationally outside of China? Are they actually going to be competitive outside of the domestic market?
Yes, that's Also, another hot topic in China right now, those new brands are actually going global. I definitely think it's possible. Actually, we're selling a lot of stuff overseas already. We have seen Shein, as you mentioned. We have Wish.com. Most of its sellers are from China. And we have a lot of other export e-commerce services. But very different from them in that in the past, we used to think that Chinese people know how to manufacture stuff, but don't know how to build a brand, right? But that has changed for actually some very simple reason. One of that is those global brands, they have their office in China for the past 30 or so years, and they have built a group of very experienced brand managers from Procter & Gamble, from Nike, Apple, those brands. These people are smart. They have worked with the top tier global brands, and now they want to build their own, and they have the knowledge, the know-how to do that. And also a lot of people like you, like me, were educated overseas. We have seen high quality brands want to build them in China. So those Chinese new brands can very confidently go to US, Europe, or anywhere in the world and saying that it's a global brand. Those Chinese brands are going to expand globally. That has not been the major focus for those new brands for right now, because most of them are still young. But I think when they reach a certain stage, say they already have 1 billion RMB in sales, they have to think globally. You have seen like Kinky Forest and even some clothing brands, they have gone to the US. And I think that might be the next big story for the next 5 to 10 years.
I personally know a lot of people working on this, and actually just Truhai or going abroad from inside of China is a very hot topic right now. Any questions from the audience?
What's the expectation from the investors, the LPs? I guess the expansion, scale up, and also the exit time frame and the multiples, because that might be rather different with purely online businesses.
Great question. I think the public market or the exit outlook is still good for those new brands, because we have seen IPOs of Pop Mart, The Perfect Diary, and also in the local China public markets. Every year we still have a lot of consumer brands that are getting listed, but those are still mostly like traditional brands. For those new brands, we can exit maybe 10 times, 20 times, or higher returns. But definitely they're not like internet businesses. We don't have opportunity like Kuaishou. You can get 1,000 times return on investment, but we're still okay with getting maybe 100 times, 50 times, 20 times, and that's still, considering your exit time frame, is still definitely acceptable. And also the risk might be lower. Kuaishou is very hard to build, and we have only one of them in the past 10 years maybe. So a lot of exit cases haven't been here yet, and that's how it is right now.
So lower returns, but lower risk, hopefully.
We're just wondering, any characteristics that you look for to spot the one which you think will survive?
I would say one of the key things is that they have to create a new product or offering or experience that you cannot be only 1 time or 2 times better than the current offerings. In consumer products, it's definitely hard to do 10 times better, but you can be like 5 times better, and we're really looking out for that. We're looking for very creative products that can attract consumers online efficiently, and something that the market haven't seen before. And I think when it grows, I think we really look for operational efficiency, how fast you're attracting your customers and how well you're converting them, and what's the ROI on your marketing dollars. And that determines how fast you can grow and how efficiently you can relevant in the market. And when it grows much bigger, they have to think about building their brands in an emotional wise, and also they have to invest in their manufacturing or supply chain.
Quick question for companies who are growing their brand in China. When they think about international expansion, when do you think is the right time, if they're one of your portfolio companies, to take their brand outside of China? Do you advise them to start on a regional basis before they venture off, let's say, into Europe or the United States?
What we see right now, if you start as a brand in China, locally first, and if you want to expand internationally, I would say a good timing would be that when you have a stable growing and strong presence in domestic market before you can think globally. Usually we see that brands reach annual sales of about maybe 1 billion RMB, so over $100 million in sales, and they'll start to think global expansion. I think that's a good timing for them, and the team has the money to spare, and also extra people they can do the international businesses. And when they start off, usually we see that they tend to focus on certain region first, and they tend to choose some select channels to start off. First, that might be they tend to just start purely online, and they try to test the water in this way and try to build an operational strategy. They can really know how the foreign customers are reacting to their product, brands, and services, and they can adjust very quickly too. And then after they have a good understanding of the local market and have a efficient kind of operational strategy, they will invest more and tend to do bigger things overseas.
Thanks so much, Albus.
All right. Bye, everybody.
That's it, everyone. Thanks for listening. And if you're really serious about China tech, join our insider community. You do have to take a quiz, so make sure you listen to all of our past episodes on China tech on our main TechBuzz China podcast. Also, a huge thank you to our editors, Carrie Huang and Bryce Ye, and of course, the entire Pandaily team for all of your help. See you next time!